Good morning, everyone, and welcome to ETFestival 2022. This is our first in-person event in nearly 2.5 years, and I have to say it feels refreshing to be at a physical event after so long, and I hope you feel the same way as well. So my name is Jun, and I'm with the research team here at iFast, and to kickstart today's event, I'll be giving you guys a short update on some of the key developments that have taken place in markets over the first half of the year. And immediately after this, we will proceed into a panel discussion where I will invite two of our very experienced panelists to join me on stage for an in-depth discussion on some of these topics, the market outlook for the year ahead, and more importantly, how you guys can position your portfolios amidst this uncertain environment. So without further ado, let's get started. So there are three key topics that I would like to draw your attention to. So the first is probably something that you have heard of and in some ways felt. So those of you who drive, you might have realized that going to the petrol station and filling up your car on a full tank now costs $120 instead of $80. Or your favorite hawker stall in your neighborhood hawker has actually raised prices. And that is because inflation is rising. As a matter of fact, inflation has risen sharply across most major economies and even here in Singapore. So Singapore's headline inflation was reported by MTI for the month of March. It grew by 5.4%, and that is the highest level since April 2012. So similar trends can also be observed in Western markets such as those in Europe and even in the US, where inflation rose by 8.3% year on year in April, which was just reported, and that is actually a little bit slower than the 8.5% in March. That was a 40-year high. Nonetheless, April's numbers are still close to the highest level in 40 years. And more importantly, with prices rising and showing no signs of easing, it's safe to say that the Fed was wrong about inflation being transitory and that higher prices is something that all of us will have to live with going forward. So there are a couple reasons why inflationary pressures are so high at the moment. So some of them, they have to do with pandemic-induced factors such as your labor shortages and your supply chain disruptions. So for instance, in the US back in January this year, when the country was actually opening up, lifting most of its COVID-19 restrictions and declaring that COVID was endemic, it actually saw a huge surge in COVID-19 cases with nearly 1 million cases reported each day at its peak. And because of that, major US ports also suffered the worst congestion in decades, with dozens, if not hundreds of ships waiting off the coast of the US to unload their cargo, and that is partly due to a shortage of workers and truck drivers at the ports. And of course, this is also because of the fast-spreading Omicron variant. So as a matter of fact, ports in Southern California, which are among the largest along the west coast of the US, at one point they actually reported that nearly 10% of their daily workforce was actually unavailable due to COVID-19 related reasons. And that itself has resulted in logistic delays, supply chain disruptions, and that further drove prices higher. As a matter of fact, freight rates have actually increased by 4 times since the pandemic started, and that itself is putting pressure on businesses to raise prices, further driving up inflation. And now, with the recent lockdowns in China, we are seeing the same thing also, and that is also adding to your supply chain woes and inflationary pressures. So at the same time, the US economy is actually roaring back to life. It's very strong. Consumer spending is stronger than ever thanks to the pent-up demand. And with most of the COVID-19 restrictions already lifted since the start of this year, consumer spending has actually surpassed its pre-pandemic levels, even in somewhere around January 2021 already. So most of these consumers who were cooped up at home over the past 2 years are starting to go out once again, and they are increasing their spending on services such as travel and dining, which is pushing up services inflation and hence overall inflation. So another reason that explains the recovery in consumer spending is that consumer finances, they remain in great shape. Household balance sheets are robust, and thanks to the generous stimulus packages and also the significant accumulation of savings over the course of the pandemic, US consumers are now sitting on roughly $4 trillion in cash, the yellow line over here, which is significantly higher than pre-pandemic levels at about $1 trillion. And because of this, they are all going out to spend. And on top of that, the labor market in the US also remains relatively tight, with the US experiencing one of the lowest unemployment rates since the pandemic started. And because of that, employers, they are having difficulties finding the kind of talent that they need. And because of that, they have to raise wages, and that increases the disposable income, and thus fueling the propensity for consumers to spend even more. And now, of course, to make matters worse, Russia invaded Ukraine in late February, sending commodity prices from food to energy skyrocketing. So both countries, they are actually very important in the global supply chain. And the war in Russia-Ukraine has actually rocked commodity markets, because Russia and Ukraine, they actually both account for, together, these two countries, they actually account for nearly 1/4 of the world's wheat supply. And on top of that, Russia is also a major exporter of energy, especially to its neighbor Europe, where it is responsible for about 40% of the continent's natural gas imports. So right now, the EU, the European Union, it is currently deliberating whether or not they want to impose tougher sanctions on Russia because of its actions in Ukraine. And this includes a potential ban on Russian oil. And if this materializes, energy prices, they are likely to go even higher than current levels. And also, Sweden and Finland recently, they have been talking about applying for NATO membership, and Russia has stated clearly that they will respond either economically or militarily should that happen. And that is also adding more uncertainty into the commodity markets. So in essence, with the crisis in Russia showing little signs of ending, commodity prices, we think that they are likely to remain elevated for the near term, or worse, go even higher, and that should add to inflationary pressures even more. Now, with inflation running red hot, the Fed has finally kickstarted the current rate hike cycle by raising rates 25 basis points after its March meeting. So earlier this month, it followed up with another 50 basis point rate hike. So just for your information, the last time that the Fed actually did a 50 basis points rate hike was actually back in the 2000s during the lead up to the dot-com bubble. More importantly, the Fed has also signaled that more rate hikes should be expected, and rates could potentially go to as high as 2% this year. And before the March meeting, the Fed was actually a lot less aggressive, as they still thought that inflation was going to be transitory, and they were only projecting about 3 to 4 rate hikes this year, and assuming each rate hike is for 25 basis points, that will bring the Fed funds rate to 1% by the end of the year. So this was what they were expecting at the beginning of the year. So this dramatic shift in interest rate policy comes as the Fed has finally realized that inflation is no longer transitory. And not only that, because of its slow action, it is now already behind the curve, and they have to hike rates quickly in order to tame inflation. So the risk of such a rapid rise in interest rates, it raises the risk of a policy misstep, which could trigger a recession if it is not done carefully. So right now, I think the primary challenge of the Fed would be to tame inflation without slowing the economy too much. And with inflation unlikely to come down sharply, I think that rates are going to rise even further, and that investors should begin preparing their portfolios for a higher interest rate environment over the next couple of years. Now, turning our attention over to China, which is probably one of the few countries that is still continuing to pursue a COVID-0 policy. Shanghai has been locked down since the beginning of April, and there are rumblings that other countries like Beijing, other parts like Beijing and Hangzhou are also going to be locked down in the future. And that is raising some concerns about whether or not China will be able to hit its 5.5% GDP growth target for this year. So in response to the slowdown, the government has actually rolled out several policies to support the economy. So such policies include things like targeted financing for small businesses, tax rebates, tax cuts, and back in April, they also reduced the reserve requirement ratio for banks to ensure that there is enough liquidity in the market. the government has also pledged to ramp up their infrastructure spending to stimulate the economy. And it's not just for traditional infrastructure such as your roads and your railways, but also for advanced infrastructure, things like your cloud computing and artificial intelligence that will benefit the country in the long term. And with regards to the tech sector, this is one of the first times that the government has directly addressed the crackdown on the Chinese tech sector that has begun somewhere in late 2020. And what is important is that they have stated that they plan to wrap up the regulatory crackdown on the tech sector as soon as possible. And on the issue about overseas delistings, so China has been facing quite a bit of pressure from the US in terms of maintaining some of their companies on US exchanges due to the audit requirements. However, earlier this year, China made a rare concession by changing some of the rules, basically to allow US regulators full access to the audit reports of Chinese companies so that they can be compliant with the US regulators' laws and stay listed on US exchanges. So overall, we remain cautiously optimistic on Chinese equities. We think that with most of with share prices falling so significantly over the past year or so, most of the negatives have already been priced in. And looking forward, we do see a number of catalysts that could drive higher share prices for Chinese equities. So this includes stronger policy support by the government and also the further easing of the regulatory crackdown on the property as well as the technology sector. And in addition, 2022 is also shaping up to be a politically important year for President Xi Jinping, as the man is actually seeking a third term as China's president. So as such, he and his government, they will likely want to show that China has actually achieved great economic progress under his leadership to improve his chances of re-election, and therefore it incentivizes the government to roll out more supportive policies and ensure that economic growth doesn't go negative. And in terms of valuations, Chinese equities, they remain attractive as they're trading at about one standard deviation below their long-term average of about 12 times already. So at this point in time, I personally think that upside potential for Chinese equities, it actually outweighs the downside risk. And with that, that basically summarizes some of the key developments that have taken place in markets over the first half of the year. But stick around and we'll be back shortly with the panel discussion. Thank you.